Welcome back to Financial Market Insights for Traders, the show where we break down complex financial concepts, market trends, and trading strategies to help you stay informed and ahead. I'm your host, Sophia. Today, we're going deep into a topic that's increasingly relevant in today's 24/7 trading culture: OTC digital options, and more specifically, the risks associated with after hours trading. If you've ever found yourself placing trades over the weekend, during holidays, or late at night when traditional markets are closed, chances are you've dabbled in OTC digital options. On the surface, the flexibility seems like a win. But once you look under the hood, the picture isn't nearly as rosy. Let's get into it. What exactly are OTC digital options? OTC, or over-the-counter digital options, are financial instruments offered by brokers outside standard market hours. That includes weekends, holidays, or even the quiet hours after major markets close for the day. Unlike regular digital options, which use real-time price feeds from exchanges like the NYSE or CME, OTC options are based on broker-generated pricing. This means the numbers you see on your trading platform aren't pulled from a public exchange. They're created internally by the broker. That distinction alone should raise eyebrows. Why? Because it shifts price control away from global market forces and into the hands of a single entity, your broker. How do OTC options differ from regular digital options? During regular hours, digital options pricing reflects the tug of war between banks, hedge funds, retail traders, and other market movers. Prices are transparent, they're public, and most importantly, they're verifiable. But in the OTC world, none of that applies. The price you see is the price your broker decides to show you. There's no external market validation, no real-time liquidity pool behind the scenes, just a price feed crafted by the platform. To be fair, not all brokers exploit this, but the risk of abuse skyrockets when the broker is both your pricing source and the counterparty to your trade. Let's talk about the risks. I want to break down 5 key risks of OTC digital options, especially during after-hours trading. 1. Price manipulation. Let's be blunt. This is the elephant in the room. There are countless stories on forums like Reddit and TradingView from users who've seen trades reverse in the final seconds due to inexplicable price dips or spikes. Here's one that stood out to me. I placed a call on euro to US dollar during an OTC session. Everything was smooth until 5 seconds before expiry. Suddenly, the price dipped just below my entry. Trade lost. A second later, price shot right back up. It felt completely rigged. In normal market conditions, price action like that would likely be driven by economic news, market sentiment, or institutional flows. But during OTC trading, it could simply be your broker moving the needle. And with no central exchange or third-party feed to compare prices, how do you even prove something shady happened? You can't. 2. Lack of transparency. This one goes hand in hand with manipulation. During standard hours, brokers rely on aggregated data from major financial institutions and liquidity providers. That's what gives you accurate charts, tight spreads, and reliable execution. OTC pricing? It's a black box. No one, not you, not regulators, can verify where that number came from. If the broker wants to nudge the price 10 pips to protect themselves from your in-the-money trade, they can. And you'd have no idea. 3. Unnatural volatility and spread widening. OTC trading can feel like the Wild West. Traders often report that technical strategies that perform well during normal sessions fall apart completely in OTC conditions. Why? Because the price doesn't behave the way it should. It doesn't respect support or resistance. It breaks key levels with no volume behind the move. One Reddit user described it perfectly. My entire strategy is based on clean price action and S/R zones. During OTC, none of that works. It's like trading in an alternate universe. To make things worse, some brokers widen spreads during OTC hours dramatically. That means even if your entry is good, the spread could eat your profit or flip your win into a loss. 4. Execution and liquidity issues. In normal trading, market depth is provided by institutions, banks, and high-frequency traders. OTC lacks all of that. You're not trading with the market, you're trading against your broker. And that opens the door to order delays, slippage, canceled trades, inability to close positions at expected prices. Even in 2025, with all the tech advances, execution quality during OTC hours remains a massive red flag. 5. Account restrictions and withdrawal delays. This one's alarming. Several traders have reported that after profitable OTC sessions, they were suddenly flagged by their broker for unusual activity. That often leads to account verification demands, delayed or frozen withdrawals, sudden changes in trading conditions, and in extreme cases, complete bans. It's a situation no trader wants to find themselves in. You're not just fighting the markets, you're fighting your broker. Are there any benefits to OTC digital options? Now let's be fair. There are reasons why some traders use OTC digital options. Weekend flexibility. You can trade when others are sleeping. Testing strategies. Low stakes environments can be useful for experimentation. Busy schedules. If you can't trade during regular hours, OTC gives you an alternative. But that flexibility comes at a steep cost, and you need to ask yourself if it's really worth it. So, how do you stay safe? Here are a few strategies to reduce risk if you're trading digital options, and especially if you're tempted by OTC hours. 1. Stick to major market sessions. The best defense is to trade when real markets are open. That's when prices are shaped by true market dynamics, not internal broker logic. Here's a quick breakdown. Asian session, midnight to 9 o'clock Universal Time Coordinated. London session, 7 to 1600 hours Universal Time Coordinated. New York session, 13 to 2200 hours Universal Time Coordinated. Trading within these windows reduces your exposure to artificial price behavior. 2. Use a transparent, regulated broker. This is non-negotiable. Look for brokers that offer real-time pricing from reputable exchanges, consistent spreads, fast execution, reliable withdrawal processes. Platforms like crystalballmarkets.com are examples of brokers that offer more transparency and security, especially for digital options. 3. Adapt your strategy if you must trade OTC. If you're going to venture into OTC territory, adjust your approach. Use longer expiration times. Trade smaller amounts. Avoid strategies that depend on razor-thin margins. Keep meticulous records of price behavior during these sessions. And most importantly, never chase losses during OTC hours. It's too easy to spiral. Wrapping it all up. Look, OTC digital options sound good on paper. Who wouldn't want to trade on a Sunday night? But the deeper you look, the clearer it becomes. This is a risky environment where the odds are often stacked against you. Price manipulation, lack of transparency, strange volatility, execution issues, and account risk. It's a lot to take on, especially when you could simply wait for proper market hours. If you want to trade smart in 2025, do it where you have the best tools, transparency, and a level playing field. That's it for today's episode of Financial Market Insights for Traders. I'm Sophia. Thanks for spending your time with me. If this episode helped clarify the world of OTC digital options, please share it with your fellow traders and leave a review wherever you're listening. And remember, trade informed, not impulsively. Until next time, stay sharp and stay safe.